Sanjay, good having you. Thanks so much for joining in. All naturally so, all eyes out on what the statement is tonight from the Fed, tonight India time from the Fed. How crucial could the statement be? Because almost everybody is taken it for granted that there is no action this time around, and September is also probably a foregone conclusion.
Yes, I think that as you said, that there is really no action that's going to come out tonight. But I think to me, what's important is how much was the Fed going to emphasize global developments that have taken place over the last few weeks, notably the slowdown in China, the poor trade data that's come out, and is the US dollar going to, which they will not refer to directly at all, but is that going to become a hindrance to US growth? So all three factors are going to be fairly important, and we don't know, but we hope they touch on these issues. Because what that will tell you is that if they are concerned about global developments, then probably you would start to see that the market prices in a rate cut after September and keeps pushing this out. So that's going to be very crucial.
Sanjay, what's the sense that you're getting about data points from China, and does it seem like the volatility for now may have settled down? I mean, what's dragging and plaguing the market is still a big mystery.
Yeah, I think that, there are two things. It's a combination of economics and market technicals. So the first point is that for a long time, there was a belief that the worse the data gets, the stronger and more aggressive is the policy response going to be. Now, that has happened. But the reality is that the data is not really improving. Even if you look at the second quarter GDP numbers out of China, yes, they got 7%. But with nearly a 30% contribution from financial services. Now, with the stock market now having collapsed, that sort of period is behind us. Then we had the PMI numbers out of China, which was, the index was at a 15-month low. So it's now becoming a bigger question mark as to where exactly and how the growth momentum is going to improve. That's the first thing. The second is when you get falls, initial falls of the magnitude we've seen, it means that a lot of margin financing trades, etc., are being unwound. So we've had a combination of the two. Now, going forward, though, I think volatility will persist. We will see some policy response, and perhaps you won't see the 8% falls in the market. But it is difficult to see that with sort of profits so weak, industrial profits data was very weak, how the market can improve materially in the coming months.
What about India then, Sanjay? Because we too have been sort of facing the heat, or rather global heat, I should say. And it's not like we're spared from volatility that we've been facing. A lot of it has also got to do with a complete status quo and standstill when it comes to both houses of parliament and crucial reforms. And of course, a lot of earnings as well, which the market has been digesting of late.
Yes, and I think that this is quite critical, that there is obviously an importation of global volatility, but there are a couple of things that stand out. One, the markets are still sort of quite expensive relative to the underlying growth momentum. Second, as you said, earnings have been disappointing, and then there's no reform. So one really needs to think whether this environment leads to a multiple compression or expansion. And I think it's quite clear that we will see a multiple compression. So partly global, partly homegrown. I do not see the Indian market doing very well. I do not expect it to collapse, but I think it's going to remain very volatile. And at the end of the year, we'll probably come up with negligible gains, if at all.
My other question to you about India is that a lot of people now are forecasting that the earnings for India, which were expected to pick up in the second half, are now being postponed to the beginning of FY17. So this year is considered to be a washout year as far as earnings go, which would probably be a factor of how the economy is probably not expected to pick up in the second half, but maybe only in the last quarter of the current fiscal. Does that change the view on the currency, on the bond markets at large, or is that still stable? Because a bunch of rating agencies have mentioned that India economic picture is on the mend.
Yes, I think that we haven't really seen any tangible improvement. And along with that, I mean, you mentioned a lot of factors and asset classes, so let me just sort of separate them out. As far as the rupee is concerned, it is looking very overvalued at this point in time. relative to the region, relative to its own export performance. If you look at the last trade data number we had, exports were down 14%. That's amongst the worst performances in Asia. So there is a need for the rupee to adjust now. There is no external pressure from the balance of payments, but there is a competitiveness issue. The second point is in terms of where do we see bond yields. I think now here, we've already seen that in that monetary policy, if the Fed moves, it's going to be a very gradual increase. So some of the nervousness should go away. The second is that the monsoons have not been as poor as initially anticipated, and therefore I think inflation would generally be in accordance with the RBS stated trajectory. So to that extent, I think the leeway of cutting interest rates has probably increased from 25 basis points to about 50 basis points. As far as growth itself is concerned, I think if there is an improvement this year, it will have to be in the last quarter, and much will depend on how agricultural incomes move. So we'll have a better picture on that, but I think there is potential for a modest improvement in consumption demand. As far as the capex cycle is concerned in the manufacturing sector, I think we are still 15 months away from that.
Sanjay, so good having you on the show. Thanks much for taking the time out and speaking to us today.
Thank you.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.